Can you quantify the balance of risks? And if the transmission channel for these awful events in the last 48 hours in the Middle East is oil, is treasuries and the dollar, then are the markets in this region in for a particularly challenging time ahead?
So I think the way we'd frame this, Sri, is that we've already seen in the past couple of weeks 3 major global factors affecting markets, and that's extended the negative seasonality, which is typical for September, into the first week of October. Markets were down overall about 1% last week, and there was about $3 billion of net selling by foreign investors in the past week. Now, the 3 key global factors, as you just enumerated, would be the shock in rates. We can go into that in a little bit more detail in a moment. The corresponding increase in the dollar, and then, of course, increase in oil prices, which went up to 95, sold off, and now just ticked up about 3% overnight. So I think those are the key macro factors affecting things. Now, with geopolitical tension having risen, that's obviously an additional factor on top of all those, and they kind of interrelate. To quantify this in, for example, our model of Chinese equities and also for the region more broadly, when we explicitly include a geopolitical risk factor, it has a somewhat depressing, it's obvious but true in the statistics, that it has a suppressive effect on valuation. So I think it's the way I would characterize things is that this is exacerbating an already a situation which already has been in place and which has been weighing on markets.
If uncertainty then is the watchword heading into 2024, Tim, then do we need to get into a defensive crouch here? And if so, what should that look like?
Well, it's a great question. It may sound heroic or perhaps foolish, but we actually have a fairly constructive view tactically on the fourth quarter. And the legs of that argument are, first of all, and this is the weakest of the arguments, but it's good for people to understand that, is that typically the fourth quarter is the best quarter by far in the year for all the Asian market. It's going back over the past 20 years. The key numbers are that on average, the broad MX APJ index returns a little bit less than 4% in the fourth quarter, and the success ratio in the last 20 years has been about 70%. So history's on your side to think that after a typically and seasonally weak third quarter, you get a bit of a bounce in the fourth quarter. And there's a lot of reasons for that. People start to position for the year ahead and so on. Now, more fundamentally, we've seen that there's been significant net foreign selling in the third quarter. About $13 billion was net sold in Asia ex-Japan, and northbound sold about $16 billion. This is the northbound connect foreign investors going into China A shares. They sold about $16 billion after net buying about $8 billion at the end of July, when the Politburo meeting encouraged some positive expectations on China at that point. So the point is that positioning is light, people have sold, markets fell quite a bit in the third quarter. Valuations, I'll just give you 2 numbers. China trading at 9.4 times forward earnings at the end of last week, and the region as a whole trading at 12.2 times earnings at the end of last week, and those are all clearly inexpensive in absolute terms at the lower end of their respective ranges. So what we can say is that a lot of the bad news that we've been just discussing has been incorporated into share prices, and if we get a little bit more sequential recovery, particularly in China, I'm sure we can get into the Golden Week holiday and policy and all sort of stuff later in the conversation, that if we see some sequential improvement in the fundamentals combined with low valuation, inexpensive positioning, and sort of the typical seasonal tailwind we see, all that should be helpful. Now, I realize that sounds a bit perhaps optimistic in the face of all these larger issues we're talking about, but just to make one final point, in terms of the run-up in interest rates, we think that the sort of the fastest or the most challenging part of that, the speed of the increase in both real and nominal rates,
is over?
Well, over is a big word, but certainly it seemed to be toward the tail end of it. We think we're kind of above fair value, a lot's been priced in, the market's going to pricing in a higher for longer environment to a more significant degree. So maybe we've already kind of digested a good part of that shock.